Interest rates are coming down. Now that sounds great to me, but what does that mean for you and for the market? And what can you expect this fall? I'm Michael Minson with the Level Up Group. We're powered by Place and Keller Williams Luxury International. Let's explore how declining rates will affect buyers, sellers, and housing prices while we tour our fabulous new listing at 261 Ripley Street in the fabulous Bernal Heights. Stay tuned after the break. Hi folks, I'm recording this in the gorgeously remodeled 3-bedroom, single-family home on the coveted north slope of Bernal. It's early September, and interest rates have been in the low 6% for weeks. We got down to 6.1% just this week. Now for context, we saw rates as high as 8% about a year ago in October 2023. We've been hovering around 7% with only modest variability. Now let's check out the updated kitchen and bright sunroom. Now this week, they announced inflation is growing at a target 2.5%, which has been one of the Fed's key indicators that they may be ready to reduce the funds transfer rate. This trickles down and indirectly affects mortgage rates, which is a welcome relief. By the time this video is out, I bet the Fed has already announced an interest rate drop. The anticipation of this announcement is probably why mortgage rates have dropped so dramatically. So what does all this mean for you as a buyer or a seller? And what do we expect to happen in this market? Well, let's discuss from the upstairs primary bedroom and deck. Now first, a little math. Sellers care about the absolute sale price because that's what is used to pay off their mortgage and put money in their pocket. Buyers care about this as well, of course, but what they care more about is their monthly mortgage payment. How much is coming out of their pocket every month? Now, as rates go up, their buying power decreases, meaning they're paying more for the same thing. As rates go down, their buying power increases. Let's assume a buyer is getting a $1 million mortgage. At 7%, the monthly payment for a 30-year fixed is about $6,650 per month. That same purchase price at 6% is $650 less, or about 10% less. And at a 5% interest rate, the monthly payment is nearly 20% less. Now, that's a significant difference, and it makes housing more affordable for a huge number of people that have been on the sidelines. It may also cause real estate prices to rise. I'll explain that from the downstairs bedroom. Now, let's look at that same math, but from the perspective of a seller. Let's consider those same buyers who are able to afford $6,650 a month for a $1 million mortgage at 7%. As rates come down to 6%, that same payment can now afford a $1.1 million mortgage. That's 10% more. At 5%, that same monthly payment covers a $1.24 million loan, which is a whopping 24% more. So as a very crude rule of thumb, a 1% reduction in interest rates increases buyers' buying power by about 10%. This is how falling rates create price appreciation. Let's go outside. I must show you my favorite spot, the casita. Now, you might say, nobody will want to pay a higher price. They'll just buy the same home for a less monthly payment, and that would be true if that was the only variable at play. The twist is that as rates come down, more buyers will enter the market as homeownership becomes more accessible. More buyers creates more demand, which also tend to cause prices to rise. So, either prices will rise because the consumer's buying power is increased, or because more buyers are entering the market, creating more demand, or more likely, both factors will be at play. However we get there, it's almost inevitable that prices will rise. So, when will this happen? Let's check out the spa-like bathroom and find out. So, the market is driven by consumer behavior, and that behavior en masse is fairly predictable. Buyers are the first to react to a decrease in rates, and it usually takes sellers longer. Buyers can act relatively quickly once they find a place they like, especially if they're renting. Sellers, on the other hand, typically need to see more evidence that things are heading in the right direction. That comes from seeing what their neighbors' homes have sold for, and what they're hearing in the media and from their friends. The selling process can take 3 months or longer once they've decided that this is finally what they want to do. So let's get out of this bathroom. As beautiful as it is, this is kind of weird. So what does this mean for inventory, especially in San Francisco's notoriously tight inventory market? Well, inventory will continue to be tight until more sellers decide it's time to make the move. According to the National Association of Realtors, 89% of homeowners with loans have rates below 5%, and 59% of homeowners with loans have rates that are below 3.5%. That makes it really hard for a seller to get excited about giving up their low rate to buy something at a higher rate. Now, as rates move towards 5% and below, and we see prices steadily increasing, more and more sellers will enter the market, and we'll start to see a balancing. But for now, San Francisco remains a strong seller's market with more buyers than there are homes to buy. Appreciation is steadily improving. The city is up 6% over last year so far. We expect that to continue. If you're a seller and you've been waiting on the market for conditions to improve, we should talk. Inventory is low and demand is high. These are the conditions that create pace-setting sale prices. And if you're a buyer that's been waiting for rates to drop, we can help too. We advise our buyers to get in the market as soon as you can so you can ride that wave of appreciation rather than get run over by it. If you're interested in checking out 261 Ripley Street in fabulous Bernal Heights, or maybe you've got a real estate situation that's been keeping you up at night, give us a call. We're happy to help.